Disney had a terrible day on the market while the rest of the market on average was moving up sharply. The S&P was up on average 1.55%, while the Walt Disney Company dropped 2.24%. That's a massive divergence. Some other ones out there you can see: Paramount, Skydance, Warner Brothers. They all had their drops. Of course, with Warner Brothers and Paramount, Skydance, there's a lot more going on, okay, with those companies in particular right now than Disney. But that industry all got kind of beat up. Here's the thing. We told y'all earlier in the year when Disney was doing their earnings calls and their annual shareholder meetings, and we saw Disney ramp back up to $120 a share or whatever, we said, guess what? We've seen the pattern. By the time we get into November, a lot of those big gains from earlier in the year are going to have evaporated. Sure enough, here we are. What's cuckoo about this is what some of the Wall Street analysts are talking about in terms of what Disney needs to do. Our old boy Jim Cramer discusses an overreaction in Disney shares. This was following the earnings call. This is from Insider Monkey. We recently published 8 stocks Jim Cramer discussed. The Walt Disney Company is one of the stocks Jim Cramer discussed. The day on this show was aired, the Walt Disney Company had just reported its earnings. The results saw the firm's fiscal fourth quarter earnings of $22.46 billion miss analyst projections of $22.75 billion, while its $1.11 adjusted EPS earnings per share beat 105 in estimates. The day ended with the stock closing 7% lower, and here's what Jim Cramer said that morning. On earnings and share price movement, that's an overreaction. Remember the day we covered the Disney earnings call, we watched Disney stock drop pretty significantly as they released their earnings. You have a dividend boost, says Jim Cramer. You have a buyback. It's an overreaction. Linear is just, if they could spin off Linear, they could call it distant, like distant. David, and you want to do experiences, which I think is the greatest division. But David, $120 million in dry dock expenses, talking about cruise ships. All I'm saying is, says Jim Cramer, you've got to get those ships in the water, and it's going to change people's perception. I've asked them to do an accelerated buyback. I think that would be terrific. That's what DuPont did, a brilliant buyback. But I think the problem is, again, they're just people who expect something from Disney that Disney can't give them yet. I will point out, just go back because it's rather shocking, the decline in Disney. It's down $10. Now, when I read over everything, I wasn't happy with it, but I can't get down $10. I was only unhappy with the Linear. $10 is a violent overreaction to a company that is generating a lot of cash flow, has a big buyback, gave you a bigger dividend, and that's just plain violent. Here's the thing. Jim Cramer is tripping over himself to apologize for Bob Iger's complete failures. He really is. That's all this is. Cramer, who admitted, we covered this article in the last week or two, he's still holding on to it in the investment club. He doesn't want to sell it because he's buried himself so deep into the BS that he doesn't know how to back out. This is the difference between people like Jim Cramer and people like me, who have actually worked in this industry professionally with clients for over 20 years. I don't get to go out there and just spout whatever bullshit I want. Jim Cramer does, because Jim Cramer is not licensed. Jim Cramer is not flying under the banner of regulatory scrutiny like real people like me are. So Jim Cramer can go on television and be a consummate bullshit artist whenever he wants. And this is part of the problem on Wall Street, is that too many of them out there, the television personalities, are the consummate bullshit artists. Yes, actually, Disney did deserve the swatting that it took the day of its earnings report, because it's been in this pattern now for years. And the Walt Disney Company, the big difference, as we pointed out during that earnings call, was the fact that Bob Iger did not jingle any shiny new keys in front of the idiots on the phone. The idiots would include Jim Cramer. It's emotionally based. Jim Cramer clearly does not understand how a company like Disney operates. He says he does, and he talks a good game, but he clearly doesn't, because he wouldn't make such ridiculous statements as the ones we just read on the show. Here's the issue. Disney stock has struggled. There are more and more articles that are trying to guide Disney into becoming a cruise ship company. And they're not wrong. The cruise ship division is one of the most lucrative, high-octane profit EBITDA generating things they have. The issue is that at Disney, the cruise ships, it's one of the tiniest pieces of the company. But Disney can scale it up. Disney could theoretically, over the course of the next 10 or 20 years, become a side-by-side competitor to somebody like a Royal Caribbean. And what Wall Street appears to be trying to do is to get Disney to move in that direction. By saying this, by having more and more of these this is Barron's. This isn't fly-by-night Wall Street. This is Barron's. What they're trying to grift on Disney right here is to say, hey, your linear cable television stuff, it's not going to get any better. You can shuffle the dollars over to streaming all you want, but the streaming profits, Wall Street does not seem to believe that profits from streaming are going to replace the profits that Disney has been enjoying for decades from linear. I think Wall Street has resigned itself to that fact. They've also seemed to have resigned themselves to the fact that Disney's theme park operations are going to be relatively stagnant for years to come. There's nothing exciting and new. Wall Street just saw Comcast Universal report a banger of a quarter for theme parks, for Universal Studios, specifically related to Epic Universe. And that is a division for Comcast, of course, that is about as small as it gets. That's not their bread and butter. That is the bread and butter for Disney. It is not for Comcast. Wall Street is maybe, just maybe, starting to wake up to the fact that even though Disney continues to brag about the fact that it has some of the biggest blockbusters, in terms of overall grosses in movie theaters each and every year, that it doesn't effing matter because Disney spends so much damn money on making these things. They're just losing money on it. And again, I know there's a lot of Disney shills out there that don't like hearing that, but that is the truth. We're at the point now that, ladies and gentlemen, Wall Street is now actively and openly calling for the Walt Disney Company to beef up on the weakest, smallest thing in its portfolio, cruise ships. Because Wall Street believes that cruise ships are the future of Disney's financial growth. And I think they're right. Can you imagine if 10 years from now that Disney is known as a cruise company? It's an admission that they're out of the game. That Disney is not the Hollywood juggernaut anymore. Even though they still have big box offices because of what they spend, it's not netting them any type of financial advantage like it was, say, from 2009 to 2019.
Make sure you're subscribed to Valiant Renegade and join us every Sunday at 6 p.m. Eastern for the live show.